Free and clear of the chatter from Wall Street, you're listening to Talking Stocks Over Beer, hosted by hedge fund veteran and newsletter writer Mike Alkin, who helps ordinary investors level the playing field against the pros by bringing you market insights and interviews with corporate executives and institutional investors. Mike sifts through all the noise of mainstream financial media and Wall Street to help you focus on what really matters in the markets. And now, here is your host, Mike Alkin.
Welcome to the podcast. It is October 8th, 2018. Hope you had a good weekend. My weekend was busy. This is probably the time of year where I am just like a kid in a candy store. I mean, this, from a sports perspective, it just doesn't get better. I mean, we have college football ramping up, right? You're starting to see how the season's unfolding. And so, some surprises, some not some surprises. We've got the NFL, right? You're coming into week 5. You're in week 5 now. You're out of the starting gate. You're starting to see some surprises, right? You see the Browns starting to do okay. And then you've got Major League Baseball playoffs. So from the late afternoon to late at night, you've got baseball. And then you've got NHL dropping the puck, opening the beginning of the season. I mean, it's just, literally feel like a kid in a candy store. You walk at nighttime. I mean, I got the clicker going back and forth. I'm watching a Dodger game. Then I'm going to watch the or the Yankee Red Sox game. And then you're flipping over to football. It's college. You got pros. I mean, it's just. I mean, for a sports fan, and some of you probably hate sports, think I'm nuts. But that to me is it just doesn't get better than that. So really exciting time of year. The weekends I have, my daughter's on kick line for the varsity at her high school, which so they perform at halftime at a high school football game. So of course I got to go watch the high school football game locally, which is won 29 straight games, a couple of state titles. So I get to watch that on Saturday afternoon. My little guy, he's in middle school. He's been playing football for all these years. Although he's out now, he got a concussion during practice last week, so he's out for a bit. But just a great time of year. Fall lacrosse for him is kicking in a few weeks. So as you can tell, sports are a big part of our lives. We take it in stride. I mean, it's fun, but it's enjoyable. And my Jets won this weekend. They dominated Denver. I mean, who knows, right? I've learned to stand an even keel, but sometimes I get a little excited. But I'm not going to bring my excitement on the Jets with their 2-3 start. So decent sports weekend, and so it was good. And yesterday I made some. I'm Italian. My mom, and I was raised by my mom's parents, who were Italians, and so making spaghetti sauce and meatballs is a kind of a big thing, and on Sundays. And so made that yesterday for the family, and so it was a great weekend. So anyway, I was, I think I talk a lot about Tesla, and I've been watching. There's so much going on, right? The volatility is probably unlike anything I've seen in a long time. You don't even know where to begin, and there's so much information that comes out. Like your head hurts sometimes following it and sorting it out, thinking about it, and the stock price vol is just unbelievable. So as I think about it, one of the things that I find interesting, and it's the whole market. The market itself is, you have this stock that's so polarizing. You have people who are wildly bullish on it. You have people who are wildly bearish on it, right? So some people think it's going to 0. Other people think it's going to 4,000. It's going to be $1 trillion company, 4,000 per share. So obviously, right? Maybe there's a middle ground. Maybe there's not. I think if you've been listening to the podcast, I'm in the camp that it is. Elon Musk is an entrepreneur that was able to sell his vision to a lot of people, raise a lot of capital. I certainly don't have that skill set on being able to dream up big dreams, come up with companies like he's come up with, and he's brought this car to the masses, right? And the Model S, the Model X, by all accounts, and I've driven in really, really pretty cool gizmos. I think it's a niche provider. I think for me, where he made his mistake was trying to bring a car to the masses and mass produce with his Model 3 from an economic standpoint. I don't think it will work for him. I think the base that he got people excited about, the $35,000 car with the $7,500 credits for the mainstream, I think that's come and gone. I don't think that it will be economical for him. I could be wrong, but that's my view. And I think that he's had to raise so much capital. He's got a significant amount of debt on the balance sheet, and I think it's a timing thing for him. I think to get to where he's been, his promises have the timeline continuously moves out. And look, I get it. People say, hey, when you're trying to change the world, you're trying to save the earth. Things happen and it takes longer than expected. Maybe, and I totally get that. Unfortunately, when you have financial commitments and that have to be paid back, that's just the way it works. And there will be someone else that can do that, right? So his first mover advantage, I think, has been wiped away as you see all the major behemoths coming out and committing massive amounts of capital to the electric vehicle business. And I am a fan of the electric vehicle, and I believe that we'll see a huge ramp up in those. But one of the things that strikes me about it all is it's the whole the financial markets, and it's interesting because it makes me think about the stock market. Anyone can invest in the stock market, right? You set up an account, you put money in an account, and you can buy or sell. And one of the things over the last couple of years I've really started to pay attention to was Twitter. And you've heard me talk about this before if you've listened to the podcast, but I joined Twitter in 2009, and I don't think I ever posted anything, but I just watched it. But really in early 2017, I started to tweet. You could tell I'm ancient. And I started to talk about it, and not Twitter, not Tesla, but I just started to get involved. And I was very suspicious of the platform. I didn't know what to think. But over time, go on a few years, I have really seen some dramatic, some really incredible quality work. And as an investment professional for decades now, there's a few things I know. One is it's hard. Two is I certainly have my share. I make my share of mistakes. I've been dead wrong on some things in the past. I've been dead right. I've been right more than wrong. That's how you have a career and grow your career. But one of the things that you do learn is how to identify financial analysis. You identify good analysis and bad analysis, and what is real and what isn't. And, for me over the years, one of the things I've always done, my stock in trade, if you will, has been field work, primary research, gathering a mosaic of information from the different parts of whether it's talking to customers, talking to suppliers, talking to competitors, stuff like that, because there's two sides to every story. And you have the company management teams that are out there talking about all of the things that a company is doing with the pluses of what a company does. And then on the flip side of that, you might have if you go to the other extreme, you have people that are out there poking a hole in it. And one of the things that you see is, the way you can get walked off a cliff as an investor is by purely putting your trust and faith in everything that a management team says, because same thing is because they're in the business of talking about their business in a positive light. And typically where you hear about the bad news is when an earnings release comes out and says, or a pre-announcement, something's bad. So the way you can defend against that is by going out and doing your own work. Now, obviously, people who are not doing this for a living don't have the time or may not have the interest or the inclination to go out and do that, but there are people who do that, right? So There's regular investors, there's amateur investors, there's professionals. Some professionals don't do that work, others do. But one of the things over the years I have been able to spot is quality work, and it doesn't. Like I said, quality research doesn't mean it's reflected in the stock price. There can be a huge disconnect between actual work, actual analysis, and where the stock price goes, because stock price is driven by sentiment, it's driven by results ultimately, but between ultimately and sentiment, there's a lot that can happen. And one of the things I've noticed in using Twitter, and I do not own Twitter, the stock, is really and Tesla just magnifies it 10x, is the level and quality of the platform as a crowdsourcing tool. And it's fascinating because you have some really, really bright people on both sides of the aisle there. But when it comes down to companies, and it comes down to visions, and it comes down to how things are going to manifest itself in the stock prices, it ultimately comes down to fundamentals. The story works until the story doesn't work, right? And why don't stories work sometimes? They don't work because at the end of the day, if it's a big hyperbolic growth story, well, growth has to be there. And with Tesla, right, you'll see the bulls say that the story is that they have triple digit growth. Yeah, well, you don't take revenue growth to the bank. Ultimately, that has to translate into profits. And for Tesla, it has been time and again being pushed to the right. And as I said earlier, you have debt obligations coming due. If you're not generating that cash flow, you have to go out and tap the equity markets. Now, this isn't, I'm not on a rant here to get into the fundamentals of Tesla, which I've done before, and people who subscribe to my work have seen my views on that. And I'm not going to share the minutia of that. But one of the things that I find interesting is there's this term FUD, right? And it would come from a Tesla bull, and it talks about fear, uncertainty, and doubt. And it's interesting, right? So every time a argument comes from a bear, a Tesla bull will respond with, that's FUD, right? That's FUD. They're spreading FUD, fear, uncertainty, and doubt. So let's take what FUD is. What is FUD? When you think about FUD, when you take a platform like Twitter, all right. So if I'm a bull, I'm listening to what management is telling me, and if I have and let's use it for any company, a really good management team has a really talented salesperson who can pitch a great story and about changing the world, about doing something to save humanity, and doing it against David and Goliath. Okay, let's talk about Tesla. Saving the world, changing humanity, taking on it's David versus Goliath. Well, that's empowering, right? And if you've tested the product, if you've driven the product, it's awesome, right? So you go from 0 to 60 in nothing. And so you have these millions and millions of fans, a couple of 100,000 buyers of the car, right? So they produced a couple of 100,000 of them. So the disconnect between the number of fans, and let's say Elon Musk has 23 million on Twitter followers, and the number of people who own the cars is different. So it's kind of like in a Super Bowl when 1969, the Jets and Joe Namath, at the Orange Bowl, there were 70,000 people there, but there have been 5 million people who were at the game. Because everyone says they were there, but everyone loves the vehicle. Okay, so on and so forth. And I get that, right? It's a powerful story, but when timelines going back years and years and years are not met, and they're pushed out, and the story changes, and production numbers and timelines change and aren't met, well, I think it's very, very reasonable to question that. And one of the beautiful things now that didn't exist for years is this crowdsourced research. And so when you think about it, when you have people flying drones over distribution points, questioning what it is, when you have people digging into filings asking about how many vehicles in a paint shop that can actually be produced and understanding the permits for that. And people post that out there. Or when you have expert financial analysis, and I can tell what's expert or not, talking about the capital structure and how debt payments work and how debt works. These are investors. Now, they may not have their real name out there, but there's a very cogent, articulate argument on the capital structure that gets considered FUD. It's fear, uncertainty, and doubt, because people are questioning. All they're doing is questioning. They're not questioning the fact that, or not the fact, they're not opining that electric vehicles aren't going to work. They may view they are, but they may view that they're going to work, and Mercedes, Audi, Porsche, Jaguar may be the ones to take it there. They're not questioning the mission of cleaner of a cleaner Earth. They're questioning a single company, and they're putting information out there that is documented. When you fly a drone over, you ask the question, what are these cars? That's not FUD. That's a question. It's not listening to the leader of a cult and saying, okay, thank you, we get it. You have the right to question, especially when timeline after timeline after timeline after promise gets pushed out. You have the right to question when you do analysis and you have things that are disconnected from what's being said. There's nothing wrong with that. It's called two sides of an argument. Now, you may have sunk your life savings because you believe he's going to save the world, or you may have a big capital commitment to it, or may not, may just have an interest in it, may just have a fervent belief that what he's doing is truly noble. Okay, I'm not arguing that, but there's another side of it. Now, where it gets interesting, and I don't know what the answer is, but when I look at some of the arguments, when they're a cogent, articulate, numerate, and financial analysis, the opposite side of those are financial analysis that questions, how do you get out of this? How do you do this? What are we looking at here? And it comes back with, that's FUD. That's not the answer. But you have a playing field where anyone could go in and buy a security. Anyone can go in short a security, just open up an account. I mean, I don't know what the answer is, but I think that people need to like just kind of step back and just say, okay, maybe there should be a financial literacy course, that 101, that, okay, this is a balance sheet, cash flow statement, income statement, because unfortunately, that's how people get run over. Now, I don't know the ultimate outcome. I suspect, I think I know where Tesla goes, and I think it gets hammered, but I could be wrong. Maybe something comes in, some jaws in its event, and all these people who believe in the story, the stock's going to take off, and they're going to be rewarded. I don't believe that to be the case, but based on financial analysis, it's reasonable to question. It doesn't mean it's FUD. And now take this for anything. Any of you listeners out there that are may not be have the financially savvy in reading balance sheet, income statements. You may want to believe in something, but there are some really solid arguments that are brought up that should be questioned. And look, sometimes, like I said, the stocks could move much higher, and companies can get bailed out, and things can happen. And it doesn't mean it was FUD. It means it was questions based on sound analysis. And I think it's so easy, and that when you have capital at work, to look at every side of it. So, I just think it's important, and I wanted to talk about it because, Tesla on Twitter. I mean, obviously Musk has been curtailed a little with the SEC settlement, but then he came out. They wanted to monitor his tweeting, and yet he comes out and goes after the SEC, and he knows how to rally the troops. It's us against them, and hey, that's fine. But at the end of the day, it comes down to fundamentals. It doesn't come down to revenue growth. Revenue growth has to translate into cash, into profits and cash flows. And that has to do, that's called, if that's going to work, that's called economies of scale that are going to generate the business. And I look at some of the analysis on the bull side, and it's just grow, grow, grow. Well, growth comes at a cost. So, if you are listening and you are a Tesla bull, you've probably made, depending on where you bought it, you might have made some good money on it. And if you are in the FUD camp, step back. Don't think that everyone has an agenda, because these guys are telling you, right? The shorty Air Force or the ground force, they're out there presenting a different opinion that comes out of the company. And there's nothing wrong with that. Question it. Don't attack it. Question it. Ask it. Because it might just save you. On the other hand, if they're wrong, they're going to lose their money and you are going to make it up. But they're presenting a different side of consensus, a different side of what's coming out of management. And I think everyone should always question that. So anyway, that's my rant. We're going to do a little uranium talk right now. And again, I'm going to preface this. Do not take if I have a company on, I will tell you if I own the stock or not. It does not mean it's a big position or a small position. It could be a very tiny position. It could be a large position. I will not tell you that. Don't make your purchasing decisions of a uranium stock. I am not a financial advisor. Do not make it based upon what I say or thinking I own it. If I own it, it means it's right for you. It may not very well be right. It may not be right for you. I bring these people on to share with you some uranium talk. We talk about their company, and then you do your own research. You should do your own research. The CEO I have on today, I own the stock of the company in the vehicle that I have. Again, doesn't mean it's big or tiny, but it's an interesting guy. I've known him and have had the chance to meet him and talk to him. It's not an endorsement in any way, shape, or form of the company, but it's something I just wanted. I always want to tell you that. But we're bringing on Mike Young, who is the CEO of an Australian miner based out of Perth, called Vimy Resources, and Mike's an interesting guy. I've gotten to know him. The project is a high-cost project. So it's not one of the low costs. It's in the third quartile on the cost. So it means it's a higher cost than the rest of them. But it's not so simple to say, oh, high cost project is not interesting. Same thing, just like you say, oh, there's a low cost project. That means it's interesting, right? There's a lot of stuff that goes into it. But we're going to bring Mike on and talk about what's going on in his part of the world and how he's thinking about the macro uranium. So I hope you enjoy the conversation. And Mike Young, welcome to the podcast.
Thanks very much. And I'm really quite chuffed to be on the podcast. Thank you.
Oh, well, good. I always love talking to people who are in Western Australia right now as you're coming out of your winter and getting into a nice spring season, getting ready to go while we here on the other hemisphere are starting to get ready for our fall and winter. So.
Well, we throw the word winter around with reckless abandon here because winter here is really like a sort of an autumn day in North America. So we're on our bicycles all year, and we don't shovel snow out of a driveway. Yeah. You can tell from my accent. I grew up in Canada, so I don't miss any of that. I've been here for 30 years, and we still go to the beach in the middle of winter. It's sometimes it's a bit windy and wavy, but it's we don't have winter like they do in your part of the world and in Canada.
Exactly. Well, listen. So, Mike, you are CEO of Vimy Resources. So, why don't you give listeners your background? I mean, you've been in the mining industry for a long time. So, share with listeners where you come from and what your experiences are.
Yeah. So, I grew up in Canada. I went to university at Queen's University, did geology. I was from an early age. I was a rock collector and really enjoyed being outside. And so I studied at Queen's, and then I spent, in fact, my first summer job when I was at Queen's in 1981 was working in Uranium City for El Dorado Nuclear, which was the forerunner of Chemico. So I was working in their Beaver Lodge operations. That mine, that was an underground mine that went down 5,200 feet. And then it closed the following year. But that was my first summer job. So I was bitten by the uranium bug, while I was still in university. And then when I graduated, I was a typical, do a bit of skiing, do a bit of mountain biking, do a bit of work to, support the habit. And two of the jobs I did in the winter of 86 and the winter of 87, I was doing geophysics for La Montagne Geophysics in northern Saskatchewan, looking for deposits. And so our clients were, it wasn't called Areva then, I think it was Kojima, Saskatchewan Mine Development Corporation. So we were working in tent camps up in northern Saskatchewan in the middle of winter on snowshoes doing geophysics. And back then,
that's real winter.
That was the real winter. That's exactly. I've paid my dues. And if it was above minus 40, we were out working, and both scales come together at minus 40. So minus 40 Celsius is minus 40 Fahrenheit.
Yeah.
Not that you really care at that point. But interestingly, and just coincidentally, our crew were the first ground crew to actually walk over the McArthur River deposit while it was still just an airborne electromagnetic anomaly. And we went out there and by this point, I was a very experienced geophysical operator. And we got back to the tent that night, reduced the data on the very primitive computers. And the data was all corrupted. And I said, okay, operator error, go do it again tomorrow. So off we went to redo it. And, nobody likes redoing work. So we were a bit grumble. And we came back and we got the same result. And they said, oh, it must be machine error. So we went and did it a third time. And by this point, the owner of the company, La Montagne, who has a brain the size of a planet, he happened to be in the camp that night. And he looked at the data and he did a little bit of, tap, tap, tap on the computer. And suddenly he filtered the data in some mathematical boffin way. And this screamingly huge anomaly appeared on the screen. And we were all sitting there. And I remember it's in a tent and we're all around the screen looking at this anomaly, this graphical representation. And he basically said, boys, you'll never see another anomaly like that again. And they drilled it the following winter, and that was McArthur. So, yeah, so, to say I've got uranium in my blood is an understatement. So having had two winters in northern Saskatchewan and having met an Australian teacher in Vancouver, I decided I'd follow her to Perth. and I just started working in the mining industry down here. I migrated towards what we call resource geology. So I'm actually, funnily enough, really colorblind. So I'm not a very good field geologist. But what I became really good at was 3D modeling. And in the early days, back in the days when graphics were done on big silicon graphics workstations, and it was all very early stage stuff. And so I did a lot of work on all sorts of commodities, including uranium, and we did feasibility studies all through the 90s, and I saw lots of deposits all over the world. And then in 2000s, we were back into another metal boom, and I went and worked for a junior gold company for a few years, and then I was offered a position as the CEO of an iron ore startup called BC Iron, and that started up in 2006. That we listed that in December 2006. We had no office, no staff, and no work had ever been done on the project. We just basically had air photos showing that there might be some iron in this area, and this is in the northwest of Western Australia, where the big iron mines are. BHP, Rio Tinto, Fortescue Metals Group. And so within 4 months, we were drilling. Within 5 months, because of my experience as a resource geologist, I knew that we had a viable deposit. I'd actually worked for 18 months on an iron ore mine in Western Australia. And we immediately turned to moving this thing into production. And so in less than 4 years from our first drill hole, we were putting iron ore onto a ship and exporting it out of Port Hedland Harbor. And, that's a very, very fast timeline, even back then. And today, it would be virtually impossible today because the approvals timelines are just everywhere in the Western world have blown out a bit. But the way we did that, and I think this is relevant to the story today, the way we did that, there were two reasons. One was focus, and it was really focus about getting in production with a very strong, I think, valid belief that being a producing mining company actually brings a lot of value to your shareholders. Mm-hmm. So I'm a pseudo athlete on a bicycle, and I know that sugar is not a good carbohydrate, but I know that low GI carbohydrates are going to last. And I kind of equate it to that. You can get your little sugar hits on the market, your little marginal gains, but to have a really valuable long-term company, getting in production is pretty key. And we did a joint venture with Fortescue Metals Group at the time, which at the time a lot of people criticized, but our company went from a $13 million IPO to a $650 million company by the time I left. And the reason I left in May of 2013 was that we just weren't growing. We were a big money making company. Mm-hmm. And frankly, I was bored, and we weren't doing any business development. We were looking at opportunities, but it was hard because you needed infrastructure. And so I got bored and decided I'd take some time off and spend some time with my family because it had been a pretty busy time. And then Vimy came along. Now, Vimy used to be known as a company called Energy Minerals Australia, and it was listed in 2008. But it was listed on the back of an asset which, the Mulga Rock deposit, which had been known in the circles of geology in Western Australia for a long time because it had been discovered by the Japanese in the 1980s, and everybody knew about the fabled Mulga Rock deposit out in the desert. Mm-hmm. So what happened was they approached me and they said, look, the company needs some new blood, some new life, we need to reset our strategy. Would you have a look at it? And so I did. And the thing that stood out for me at the time, and still does, was how big it was, how simple it was, and the fact that there was no native title on the property, which is quite rare in Western Australia. But because it is in the Great Victoria Desert, in basically what is an inland sand sea, mm-hmm. The Aboriginal people just didn't live there. There was no water and no way of sustaining life. So it had sort of ticked all the boxes, really. And a gentleman named Julian Tapp, who used to work at Fortescue Metals Group, with whom I had a very good relationship, was also not working at the time. And he's good at a lot of things. He's an economist by trade, but he's actually very good at approvals. And I thought to myself, right, he's going to be key. This isn't going to be about metallurgy and mining. This is going to be about approvals. So Julian came on board as a director, and then to sort of finish off the trifecta, I asked an ex-government minister, state government minister, Cheryl Edwards, to join our board as the chairman. Now, Cheryl, very smart lady, a lawyer, first female attorney general in Western Australia, but she was also at one point Minister for the Environment. And Cheryl's one of those rare politicians where both sides of the aisle respect Cheryl and actually like Cheryl, and she can work with both sides of politics. So it didn't really matter who was in power. Cheryl would be able to cut through and get to the nub of issues with the parliamentarians and the various bureaucrats. And importantly, she is bilingual. She speaks English and she speaks bureaucrat, which is something I just don't do, right? So, and that's a real gift, I can tell you.
Yeah, nor do I.
I don't think the bureaucrats speak bureaucrat. Anyway, so that's kind of how we got to where we are. Like, on a personal level, my wife's she runs a medical research foundation. She's a CEO at a medical research foundation. I've got a 15-year-old daughter who's in grade 10 this year, and she's a gun rower. She wants to be an astrophysicist. So
that's awesome.
Yeah, I think it's fantastic. She loves math and physics and loves rowing. So her dream is to get a rowing scholarship to MIT. So good luck to her.
That's awesome.
I said, honey, you're going to have to aim much higher than that.
So that's great. So 2013 is what, so you're looking 2013 now, that we're 2 years into a uranium downturn at that time. It's interesting. You and I we've met several times and we talk. And so as you're looking at this project, what about the project stood out at that time? Because it's not near advancement. The market in 2013, 2014 is still right? People are still hoping the Japanese are coming out. There's a lot of hope in the market at the time, and there's this hope that the Japanese are getting restarted. Walk us through your view for Mulga Rock project then, where it is today, and how it's unfolded compared to what your vision was at the time.
Yeah, that's a fantastic question, which I expect that from you, Michael.
My wife
basically,
my wife and kids wouldn't, but we'll go with that.
Well, on a professional level, I think. Well, the key thing was at the time. Let's not forget that back at that time, I think the uranium price was probably in the 40s or 50s. So
yep.
The price was higher than it is today, and I think one of the things was at the time there were two things that we believed at the time that frankly didn't come to fruition. One was that the Japanese reactor starts would come on a lot quicker than they have. Yeah. And the second was that the Chinese inland build program wouldn't have been delayed as long as it was. So there were two pretty important aspects on the demand side, and certainly on the supply side. I think Andrea Janetta at Fuel Cycle Weekly put it best when she said, "You never know what Kazakhstan's going to do until they've done it." Mm-hmm. And I think that's a truism. And so I think those things were working together. That you had the demand side wasn't growing as fast as people thought it might, and the supply side was oversupplying. And I think that's been the theme for the last 3 years. And it's taken a while for Kazakhstan particularly to, for lack of a better term, to westernize. And I think Riaz Rizvi coming into that group, he's been a major contribution to the way that they're now approaching business. Yeah. The deposit itself, as I said, at the time, it kind of, for me personally, it was in my sweet spot. So as I said, I'm not an exploration geologist, I'm a resource development person. And this thing had enough drilling on it that you could move it into a feasibility study. And that's really my strong point, is that development from exploration to mining. That's what I like doing. And so the key thing for us was when we took over the company, Julian and I, it really was in bad shape. It had a pretty messy balance sheet with a lot of debt. And we really struggled to get traction until the gentleman who actually owns 40% of Fortescue Metals Group, a guy named Andrew Forrest, he put some money in. He put $12 million equity in, and then that catalyzed the conversion of the debt to equity. That cleaned up our balance sheet. We decided, because of the history of the company and because its name, Energy Minerals Australia, was very confusing, considering there was Energy Resources and Energy Metals Australia, we changed its name to Vimy Resources. And Vimy is just sort of a nod to my Canadian heritage. It's a famous battle in World War I that the Canadians were very successful in, the Battle of Vimy Ridge. Importantly, it didn't translate into anything embarrassing in Chinese, Japanese, or Korean, which is something you always have to check. Yeah. So that was kind of where we started. Now, one of the key elements, I suppose, to our success was when a gentleman named Tony Chamberlain, who's our COO, literally walked in the door and said, "I've been watching you guys. I like this deposit. I know this deposit. I'm a uranium metallurgist. I want to work for you guys." And that really was one of those watershed moments where you just have to pinch yourself and say, wow, did this really happen? Because he really is a hugely intelligent, diligent, hardworking engineer who is a rare breed in that he can actually run a budget and run a schedule. So he's a real package. And Tony's been, really critical to this project. And so under his guidance, we took the project through a scoping study, a pre-feasibility to feasibility study. And, even Tony said to me at the time the feasibility study finished earlier this year, he said, "I've just never worked this fast on a project." And, he said that working for someone like me with my boundless energy and, my ADD, he said it's been quite a ride and he really enjoyed it. And that's how we got to where we are so quickly.
So Mike, when I look at a mining project, simple is better, right? So you like to see simple geology. You like to see mining that's not complicated, the metallurgy that's fairly straightforward. That infrastructure, everything's pretty simple. So talk about what you're doing, as we go through those different categories with Vimy, let's talk about the geology of the project.
So geologically, it's basically an old river channel. Australia's had various episodes of being covered in Amazonian rainforests and high water tables, and right through to being a desert. So this is actually an old river channel, and the river channel had a lot of organic material in it. So it then got buried by other sediments, and it literally is a low grade lignite. That's the best way to think of it. It's almost peat. It's unconsolidated. It's a sandy sort of lignite, and it's about 50 meters down. Now, through various geological processes, there's been this what we call supergene alteration has occurred. And the best way to think about it is it's pretty much the same chemically as a roll front deposit, where you've got an oxide and a reducing boundary. And at that boundary between what they call a redox boundary, reducing, oxidizing, you get enrichment of uranium. Now, if you just take that and make it horizontal, that's what we have. So we basically have a deep, unconsolidated paleochannel, an old river channel with carbonaceous organic material that has trapped the uranium. In terms of its geometry, it's flat. The main deposit, which will sustain the operation for the first 10 years, the Ambassador deposit, is about 8.5 kilometers long. I remember putting it at the bottom of, on Google, I put it at the bottom of Central Park, and it pretty much made it down to Battery Point, right? That's how big it is. And it's about 2 kilometers wide, and it's about 50 meters deep. So it's just a big slab of free digging carbonaceous material. So to prove that it was free digging, during our feasibility study, we dug 2 test pits, both 50 meters deep down to the ore body. And what we really wanted to understand was, for lack of a better term, the diggability of the waste rock, because the strip ratio is about 15 to 1, 15 cubic meters to every pound of uranium we pull out. And so we had to really understand, that's our key cost. Our single biggest cost is removing the overburden. We really wanted to understand it. So we dug these 2 test pits. Cost about $2 million, took about 6 months all up. And we dug them down to the ore body, collected 100 ton of ore. And then we used that in the next process that I'll talk about. So from that, we knew that the mining would be simple. There would be no drilling and blasting. We could use big equipment, and free dig this thing. So that was the second thing about its simplicity. And really importantly, by doing that, we knew that we could actually own or operate the mining fleet. So if you've got a complex ore body that requires drilling and blasting, the ore body is complicated. You have to be very diligent with your drilling, blasting, digging the ore, blasting the ore. You would get contractors in to do that. Because this is quite simple, it's about removing the overburden, then mining the ore. The ore is and the ore boundary, I might say, is very visual. It goes from this bleached white sandy material into black ore, and you can literally put your finger on it. So it's a very sharp contrast. You've also got the added bonus of being able to use Geiger counters or radiometrics to see where the ore is. So there was very low risk in the mining. And that's a really important factor, because if we're owner operate, that margin that would normally go to a contractor comes to us. And it does make a significant cost on our mining costs. And then metallurgically, basically what happened is, as you had this old river channel sitting underground with this organic material in it, the water was still moving through the sand. And as it was moving through the sand, it was carrying metals, lots of metals. And one of those metals was uranium. And the carbonaceous material would literally trap the uranium. And so we actually have, it's so simplistic. We have basically what we call hexavalent or free uranium stuck on carbon, or it's uraninite, which is UO2. So metallurgically, it is as simple as it gets. And then so all you have to do is reverse the process by using chemistry. So basically what we do is we take the ore, we wash the sand out of it, because the sand that's in the ore is completely inert. And it's actually a beautiful white sand that would be great for sandboxes. We would wash this material out just using sand mining technology, so off the shelf. We then put it through acid leach. pH of about 1.5. I think we heat it up to about 40 degrees, which is the ambient temperature for half the year.
Mm-hmm.
That then releases the uranium. It's about 1 hour residence time, and then we now have this free uranium in solution, and we put resin beads in there, so it's called resin and pulp. It's a proven technology. This is one of the areas of Tony, our COO, his expertise is this resin technology. So we've got the right resin for the conditions, and then once you have that, you strip the uranium off the resin and precipitate what we call UO4. So it's yellow cake, and the process is just about managing your chemistry in your tanks, which is, gosh, we've been doing it for over 100 years in Western Australia in various forms of metal extraction. So again, not complicated. And once it's in yellow cake, we would truck it to Adelaide, which is down on the South Australian coast, which is currently the shipping port for both Heathgate's 4 Mile project and Olympic Dam. So again, no problem with the export licenses, no problem with the logistics. We've already approached Port of Adelaide about that. So, all of those things are, as I say, very simple. Where it starts to get complex is the economics, is the current uranium market, the incentive price that we need to get the thing going, and then funding the capex for the project.
Well, Mike, it's funny. We were talking, you and I were talking in the past, and I said, everyone, I want to meet that uranium producer that's not in the lowest decile or quartile, because every presentation you see says, and we are one of the lowest cost producers in the world. And I joked with you. I said, I still want to meet that. And you said, oh, that's us. We're not. So
that's right. We're third quartile. Yeah.
Yeah, third quartile. So, and that's it. So right now, with spot prices at $27 a pound, people look at, $60, $65 a pound and say, my God, look at that. When's that ever going to go into production? Right. And if you're casually observing the industry, you might think, well, that's a challenge. But if you see the historical patterns, and if you understand supply demand, one can, as I have, believe that that's a very real possibility and very likely. But talk about where you sit on the cost curve and how you think about it in this $27 environment.
I'll answer that by answering the last question first. I think it's worth thinking about the history of, you say the $27 environment, and of course you're referring to the spot price.
I'm referring to spot, not term.
Of course. And I think it's important for your listeners to sort of understand the history of the spot price. So every presentation that has both of those on it, and certainly our presentation has a very good diagram of spot and long-term contract prices. Up until the run-up in 2007 to the spot uranium price, there was very little difference between the contract price and the spot price. And that's because the spot market was really somewhere where the producers would put excess supply and the producers could go in and manage their stockpiles. There was no arbitrage. There were no traders. Mm-hmm. 2007 hits. You've got relatively cheap debt. And suddenly traders start getting into the market. Yeah. And the way uranium is traded, as you know, but just for your listeners, is most of it is traded on contract. And these are contracts that are 3, 5, sometimes 10 years. Cameco did 10-year contracts just after the big spike boom. And of course, in that 2007 uranium spike, everyone panicked and locked in long-term contracts. Now, there was still excess supply. There was still people putting supply into the spot market. But the spot market quickly became that arbitrage market again. And there's one thing you look at the uranium price, you'll always see from about January 2008, just after the spike, the spot price has always been higher than the contract price. Mm-hmm. Sorry, the other way around. The spot price has always been lower than the contract price.
Yep.
And that's because it's an arbitrage market. So by that, I mean that traders will buy small consignments of uranium. They'll amass those assignments, and that could be yellow cake, unenriched uranium hexafluoride. It might even be enriched uranium hexafluoride, but they're buying it in all parts of the fuel cycle. And then when a utility asks for a request for proposal, they've got enough, or they've got enough uranium locked away, or they've got enough forward contracts locked away that they can bid into that, and they get it at the higher price.
Mm-hmm.
And that's arbitrage, and that's the way they work. Now, the problem with the spot market is it's not a clearinghouse market. It's not a normal market like the London Metal Exchange or the gold market, where producers are selling it into an open market. This is an arbitrage market, and we've done a lot of work on this. Julian Tapp, particularly, who, as I say, is an economist, and we can actually see trends in the spot market where at the end of month, in a normal trading cycle where there's no significant catalysts to the price, we can actually see the price come down at the end of the month. And everyone knows anecdotally it happens, but Julian's now seen it statistically. And then towards the middle of the month, the price comes up, and it's about on average 2%. And that's just creating this little 2% buffer in the middle of the month when they might be buying and selling their uranium, but towards the end of the month when the contracts are fixed, that price comes down.
Mm-hmm.
So because there's such small volumes in the spot market, because it's not a true clearinghouse market, and because it's an arbitrage market, it's almost always going to be linked to the contract prices. So it's always going to be whatever the contract price is, less cost and less margin. And you can see that on any graph. It's almost always consistent. Follows it like no other spot market. I used to work in iron ore, and there was a spot market and a contract market, and they were never in sync. And you were forever fighting with customers about what to do about this difference, because sometimes you're in the money, sometimes you're out. But this market is always that one always follows the other because it's a margin arbitrage market. So the problem you've got is that the only market that is visible is a small volume, not openly traded arbitrage market.
Until this year, where the volumes are blowing out this year.
Yes, and we'll come to that.
Yep.
So we have to think about the contract market. Now, trying to find out what contract prices are is very difficult, as you know. Yep. And the other thing that's happened is as the prices were coming down during the 15, 16s, and in 17, the utilities were sort of extending their stockpiles. Now, this is another thing for your listeners, the people that aren't as in tune with the market as you and I are.
Mm-hmm.
The utilities will run 2 to 3 year stockpiles because, well, the nuclear fuel cycle is about 18 months to 2 years. Mm-hmm. So by that, what I mean is when the uranium leaves my gate and gets on a ship and goes to, say, France or Port Hope or America to get processed, to go from my mine gate to a fuel rod going into a nuclear reactor is about 2 years.
Mm-hmm.
And so, and they might want to have a year's worth of fuel rods, or, how they manage their fill cycle. They might have 2 to 3 years of uranium in stockpiles around the world. And that's normal. And that's another thing that's really strange about this market. So steel makers don't run 3 years of iron ore stockpiles, right? And, nickel producers don't run 3 years of nickel stockpiles, but we run 3 years of uranium stockpiles. So when it comes to contracting, you have to be thinking 3 years out. What's the price going to be in 3 years? What price will a guy agree with me today to pay me in 3 years? And this is where it comes back to your second question. How do we get to $60? Well, the answer to that is that while the spot market has basically been drifting down as contract prices have drifted down, because the number of contracts being written has dropped away, as you know. I don't think anyone's written a contract this calendar year. Yeah. Or by that I mean the American utilities mainly. That's the market we want to be in. But when you look at the cost of production, and again, we've done a lot of work on this, and there's a lot of mythology out there on the cost of production. One big myth is that the Kazakh operations are running at less than $10 a pound. Well, yeah. They're not, because their accounting was not westernized. And when you actually look at a westernized style of accounting, when you include their well development, yep. which is the equivalent of me removing my overburden,
yep.
suddenly their costs are in the low 20s. And, recently...
sometimes higher.
And sometimes higher.
Yep.
And, there was a really good piece done just after the World Nuclear Association meeting in September that was done by Cormark Securities out of Toronto. And they had talked to one of the JV partners in Kazakhstan, I think it was Uranium One, and they'd said, look, we think the costs are actually in the mid-20s. And, certainly I've had those discussions with Kazatomprom, and that seems to be the case. So we've done a lot of work on this. And we've got Joy and Tap's done a lot of work on the operating cost of uranium production. In a normal market, so nickel, copper, markets that I've lived and worked in and breathed in, what happens is metal prices always equilibrate at what we call the marginal cost of production. So the marginal cost of production, for your listeners, is basically the highest cost producer that's still operating in an environment, a certain environment. So with the uranium market right now, I think the miners are producing about 165 million pounds a year. And the highest cost producers are in the 50s. And that's just cash costs. So now on top of that, you have to add capital, return on equity, all of those things. And what I want to come all the way back to is the lowest cost producer on the cost curve, leaving Olympic Dam out of it because that's a byproduct, is McArthur River. McArthur River is the lowest cost producer. So that means when you look at the cost curve, they're in the first quartile. I think they own it.
Yeah.
When you look at the cost curve, they are the cheapest producer. That means everybody else to the right on this curve is higher cost, and some are, almost double. If they cannot get contracts to sustain production at one of the lowest cost mines in the world, what does that say about the rest of the curve at today's prices? What it says is we're either going to run out of uranium or the utilities are going to start paying closer to the marginal cost of production.
And you see
and
it
that's
like
where
in the 165 was coming into the year. And then you back out all these cuts that we've seen and it's a meaningfully lower number now because, on that cost curve, one that comes to mind would be Langer Heinrich, right?
Correct.
One of the bigger mines owned by Paladin in Namibia, right? They can't make it work, so they have to cut production, and you see it across the board in some of these mines. Yeah.
Well, you do, and you're quite right. So, in fact, the numbers are that primary supply in 2016 was 162 million pounds, and with all the cutbacks, but also putting in the 4 million pound of the Husab ramp up, supply in 2018 is 125 million pounds, and expected demand is 172. So you've got this big shortfall. Now, short term, the stockpiles around the world will manage that. Short term, some of the utilities will just sit on their 3-year stockpile and let it dwindle down to 2. But, and 232 has complicated it, but we would expect the utilities, and Duke Energy's put out an RFP, we would expect the utilities to start contracting from about now through, especially in April when the 232 decision is expected to come down.
Yeah.
And
just for listeners, Mike, those who don't know, I'm just going to quickly mention Section 232 was brought to the U.S. Department of Commerce by Energy Fuels and URANIUM, 2 U.S. miners, and they're asking on the grounds of national security relief from the U.S. government to the U.S. mining industry by they want the U.S. Government to mandate through quotas that the U.S. nuclear power plants buy 25% of their uranium from U.S. miners versus about 2% now. And the reason for that is they're saying that they import in any one year 35 to 50%, depending on the year, of their uranium from Russia, Kazakhstan, and Uzbekistan, and that provides great geopolitical risk and a risk of national security. And Section 232 is a rule that was put in 1962, where on the grounds of national security, the Commerce Department can recommend to the president that this be put in place. And simply the U.S. miners that did this are saying, look, foreign state subsidized uranium is making its way in here, and it's causing the U.S. miners to basically not be able to have an industry. And nuclear power provides 1/5 of the electric grid and lights 1 out of 5 businesses and homes in the U.S. The U.S. nuclear Navy relies upon it, and yet we're not going to have an industry. We can't compete if prices don't go up and this dumping of uranium doesn't. So That has caused U.S. utilities were in the midst of a contracting cycle, because it had been many years since they've procured the uranium for their future, and that was about to take place, and then Section 232 was filed. So rather than them enter into prolonged contract discussions through requests for proposals, RFPs, they've just stepped back and say, wait, let's see how this is going to play out. So that's what Mike's referring to with Section 232.
Now, here's something really interesting about 232. So as you say, it came out in 1962. There have been 30 investigations, including the uranium ore and products one of 2018. The one that your listeners would probably be aware of was the automobiles industry that was initiated by the Secretary of Commerce, which I think is still in process, and also aluminum and steel, which had positive outcomes. Now, of the 30 that were done, there were only 11 positive outcomes, but 6 of those positive outcomes were initiated by government departments, Secretary of Commerce, mainly. Okay. Mm-hmm. So what that tells you is that the ones that were done by private, either, associations for manufacturing or companies, have almost always been negative. Mm-hmm. And that was a really interesting little bit of information that Julian dug up. So, where's it going to go? One of the fuel buyers, when we were in London, put it best. He said, "We've done 1,000 scenarios, and then it goes to Trump." So it's President Trump, I should say, President Trump, with due respect.
So in other words, flip a coin.
No, but the truth of the matter is that even if it were to go to, I guess would be the worst outcome, which is a 25% coming from America, it would take 10 years for the American uranium industry to gear up to, what would that be, 14 million pounds a year. Look, our view is it won't get up in its current form. There may be tariffs, there may be some other mechanism. I'm now starting to think there won't be anything, because it may be that the Commerce Department just looks through what it really was, and it really was these companies just pulling every lever they could. And you've got to remember the context. So basically what happened was these guys, they're 2 producers in the Western United States, smaller producers, trying to get contracts with big utilities. And then in 2017, the steel and aluminum 232s came out from the Secretary of Commerce, and they would have looked at that and they would have said, hey, why don't we give it a shot? I suspect, or I speculate that they probably wanted to use it as a catalyst to say to the utilities, hey, why don't you guys come and talk to us and we'll withdraw it. But once it was in the system, it kind of got out of their control and it became what it is. And it's going to be interesting. I think the Commerce Department is starting to release some of the submissions, and it's going to be some fascinating reading to go through and see what the various viewpoints are.
Yeah, they have. You started to see a number of, I think there were over 800 submissions, and they started to, that they solicited from the public. So there's some, right, that's on both sides of the, you see every view you can think of is represented there. And, it's wild. I think, my view is will it be 25%? Like my own personal view is probably not, that 12, 14 million pounds would be difficult. I think from my view, it's less than 10 years, and it could be, but still, I think something will be done. I don't think it's along the order of magnitude that they're asking for. But for me, it's about clearing the market. Markets hate uncertainty, whatever the market is. So once there's certainty and markets could get their head around what it is, then it sorts itself out. And in this case, certainty is from the U.S. fuel buyers, who will say, okay, at least now I know who I have to buy my uranium from, right? So I once it comes and clears, I think that's a good thing. And how one plays it, whether they want the U.S. miners or they want, African miners, Australian miners, at least it gives the utilities a reason to get back in and start that. So
that's right.
Right. So on this cost curve, so now you talk about, okay, you got to get to $60 uranium. For that's how your project is based. And so a bear is going to look and say, okay, well, that's a long way away. So, but talk about the steps and how you, first of all, talk about on Mulga Rock, talk about the size of the deposit, the mine life, and how much per year you're going to produce out of there if you're able to get into production.
Sure. Well, it's about a 15-year mine life. There's probably a good chance to extend that by 5 years with further exploration in one of the second deposits. We'll produce 3.5 million pounds a year. Our cash operating cost will be about 25, and our all-in sustaining cost for the first 5 years will be about 30. And I say the first 5 years because we'll be mining higher grade parts of the ore body in years 1 to 5.
Mm-hmm.
So that's kind of where we are.
Mike, your break even price when you're looking at a capital payback period and a discount rate on the project, where are you putting your break even price?
It's about 44 break even for life of mine, and the first 5 years about 40. So, it's in that low 40 range is our break even price. So our incentive price will be, it's going to depend on the cost of capital, but I would think that mid 50s to 60 will be where we'd say yes on it.
Okay.
So we're not that far away. I think if the spot price gets into the 30s, which it certainly looks like it's heading that way, and there's more action with Cameco, of course, coming into the market, seeing how deep the pool is, and probably finding it's only ankle deep. But as we see that move to 30, mid 30s, with that constant arbitrage we've always seen, if you're at 35 on the spot price in a market that's moving up, then getting 55 isn't a stretch. When you look at the historic arbitrage. The other interesting thing is the way the utilities buy fuel. So again, quite different than other commodities. They like to have portfolio management. They like to have, and you think about what they're doing, right? They're running a nuclear power plant. Their security of supply and their diversity of supply are really critical. And so, yes, they do buy, I think 39% of American uranium is coming from the Central Asian republics. And then a lot of it's coming from Canada. So they are keen, and this is directly from them to us. They are keen to see new entrants, particularly from Australia. So that works in our favor.
Mike, what's your mine cost is going to run upwards of 500 million Australian? How are you thinking?
Yep. So it's about 493 Australian, which I think the dollar's at about 0.7, which ironically is the number we used in the feasibility study, and people said that'll never happen. So here we are at 70 cents. So that's about 300 US. Now, importantly, part of that's our mining fleet. So about 70 million of that is a mining fleet, and that'll be done off balance sheet through lease arrangements with the providers. So some of that capital is not up front. There's about 250 US that's upfront capital. Part of that's pre-stripping, so we have to dig some of the original pits, which we will use as our tailings facilities. So this is an important distinction with us, is that we won't have surface tailings facilities. We'll be burying the tailings back into the pits, for which we have environmental permission, and that's a really important management issue. And then part of that, the plant equipment's about just trying to do the conversion in my head. Probably about 200 US for mining plant equipment infrastructure. So it is remote. We do have to build a camp. We have to build an airstrip. We have to build roads. But that's, to Western Australians, that's not risky because we do it all the time. All the new mines in Western Australia are built in very remote regions.
And so talk listeners through this cycle from the time you decide to move forward, you get your financing. What's the amount of time before you're producing ore out of the project?
Yeah, it's 2 years. So it would be from the final investment decision when we're all up there with the silver shovels taking happy snaps, breaking the turf, to producing our first yellow cake. It's 2 years. And again, that's a timeline that's been put together by Tony Chamberlain, who's our COO, and this is something he's got experience with. And I might just add a point. So our board and senior management have all started mines before. I've taken the BC Iron story. We took it from first drill hole to first ownership in 4 years. Julian Tapp was on the JV committee with me, and he was also at Fortescue Metals Group. It's a, multi-billion-dollar iron ore company. He was employee number 11. Tony's been involved with mine startups. Our chairman was involved with another iron ore company called Hancock Mining. So we've got a team of people who have built mines. This isn't something that we're frightened of or something that we consider to be risky. So having that caliber of people in this situation for me is really key. And it really has been our strategy. I like to use the metaphor of a surfer in the water, and he's on his board in the takeoff zone waiting for the set to come in. And I'd rather be that guy on his board in the takeoff zone than some guy on the beach sort of waxing his board or getting it out of the car. And, in my view, when you look at our peers, we are up there. You've got a few like Berkeley who are, they're actually pushing dirt around. But amongst the other peers, in terms of where our incentive price is and where the project is in terms of its, in the cycle and in approvals and studies, we're ready to go. And that's been our strategy. And certainly we've acted on that. And then on top of that, just quickly, we did buy the Alligator River projects in the Northern Territory from Cameco. As Cameco was contracting around the world, that was an asset that came up very suddenly. We acted very quickly to get that asset, and we're up there drilling right now. And what we're seeing are good indications that there's something up there and worth following up. So that's really for us. That's a pretty exciting grassroots exploration area that gives us a pipeline of projects.
And talk about Alligator River. So, how much is it? Much of a capital commitment for you guys?
Not at the moment. I'd love to spend about $10 million on it. So Alligator River is part of what's called the Alligator uranium field in the Northern Territory. Now, this is where Ranger and Jabiluka are. This is the same geology, the same formations. Jabiluka is a 350 million pound deposit. It's a big deposit. And what happened? So this Alligator River province is basically, I like to think of it as Canada's Athabasca. Now, part of it's covered by a national park, so that's kind of off limits. But the area we have is the biggest single tenement block in that entire Alligator River province. And it's quite large, and we have some good graphics in our presentations that show that. But one of the things that's really exciting for us is in Australia, back in the 1990s, the then government, to get votes from green, left-leaning people, brought out what was called a 3-mine uranium policy. And at that time, there were 3 mines operating in Australia. So that basically just stopped all exploration in the Northern Territory. And while that was happening, the Canadians were discovering Cigar Lake, McArthur River, Millennium, Rough Rider, Triple R, things like that. And nothing was happening here. So we're basically, it's a bit almost like a time warp. We now have this opportunity to do modern exploration in a region that just hasn't been explored for 30 years. And we bought that from Cameco. We've already defined a 26 million pound resource at 1.3%, which is quite rich. And even in this market, that's something that could be economic. And so our intention there is to really go and look at all the targets that have been worked up by Cameco and drill them. And we've started drilling. We're getting good indication in some of the holes now, and certainly there's a lot more work to do up there. But what that gives us is sort of another arrow on our quiver, particularly grassroots. And it's important to the utilities because they like to see, Mulga Rock 15-year mine life to a Western Australian geologist. That's like, wow, that's a big mine life. But to a utility, they're thinking on terms of 30 years. So they want to see a pipeline of projects, and this certainly gives us one.
So while you'd love to spend $10 million, your board won't let you. So, what would that? What's your capital? Just to focus.
Yeah, so we're spending $1.8 million this field season. So much like Canada, we do have very distinct field season in the Northern Territory because of the monsoonal rains that we get in summer. So, we're winding down the current field season now. We've got another week or so with the drill rig, and then we'll close the camp for the summer. And then next year we'll go back in there. We haven't determined the budget for next year. It'll really depend on what money's available. Obviously we have to raise money given the state that we're at. But we'll just basically, I can't really say what we're going to spend on it, but having spent 1.8 million this field season, it would be at least that and then some. So, we've got some good targets worked up. The guys are doing some good regional geology to find more targets, and it's our biggest problem is going to be which target to drill. It's one of those in the famous words of Donald Rumsfeld, it's a target-rich environment.
So, I get asked this question a lot, and I've answered it a lot. Well, when you think about, you need the uranium cycle to work for for the investment thesis, for my thesis to work. The uranium the price has to go up. As you look at the landscape and you live, eat, and sleep and stuff, what is it that most worries you that would cause uranium pricing to stall out or to go down?
I suppose it's the uncertainty on the demand side is really the key thing, I guess. Supply side, there's a lot more discipline, a lot more certainty, and ironically, because there has been such a long winter of development, there's very few new developments. So if the demand side were to stay growing at, say, 3% per annum, we'd be in very, very good shape. But it's the uncertainty of, the Belgians wanting to close their reactors. Sure, England's building another reactor. The American reactors, a lot of uncertainty there. There's uncertainty in the unregulated markets in America with regard to gas prices.
Yep.
Certainly the pressure comes from, the subsidized wind and solar. Now, I mean, I'm just going to get political for a second, but it defies logic to be giving subsidies to uneconomic power sources to make them economic, making the economic power sources uneconomic. And, nuclear is a non-emitting power source. It's safe. It's proven. It's 24/7. And, I think hopefully with the new doomsday scenario that came out from the IPCC, hopefully it gets people thinking that nuclear has to be part of this. Nuclear has to be part of the solution. And you're certainly seeing some high profile, what I would call true environmentalists, not what we call watermelons, green on the outside, red in the middle. True environmentalists are basically saying, yes, nuclear has to be part of it, right? Because we're not going to get there. I mean, there was a study came out the other day. If America was powered with just wind, 1/3 of the United States would have to be covered in windmills. So, you look at, how the power density of a nuclear power station. I mean, if people are serious about reducing greenhouse gases, and certainly China is driven by more than reducing greenhouse gases. They're driven by the fact that their pollution kills 1 million people a year. So, my worry is that we stop building nuclear power plants, but my hope is that the world looks at it and goes, we need them. There's no way out of this problem we've got unless we build them. So that's the thing. It's a sort of existential threat. That's sort of something I can't control, so I don't lose sleep over it. But it's it's always right there in the middle of my head.
Yep. Okay. No, that's good. Well, listen, I enjoyed catching up. It was I think we saw each other in London about a month ago at a conference, but always good chatting, and really appreciate you taking the time to talk with my listeners.
That's no problem at all. I'm always happy to have a chat, and if you want to chat about bicycles and cycling or anything like that. But I'll see you in Boston, I hope.
Yep, you'll see me in Boston in a few weeks. Absolutely.
Excellent. Well, I'll be there, and I will have just been in China as well, so I'll give you some feedback on that.
I look forward to it. It was great catching up.
My pleasure, Mike. See you soon.
Take care. Well, I hope you enjoyed the conversation with Mike Young. I always enjoy chatting with him. He's always brings differentiated view into it. Now that he's been in Australia for 30 years, you hear part Canadian accent, part Australian accent, and it's always good to chat with him. So I just want to let you know that I am the co-founder and chief investment officer at Sachem Cove Partners, LLC. And due to industry regulations, I don't discuss any of Sachem Cove's funds on this podcast, and all the opinions expressed by the podcast participants are solely their own opinions and do not necessarily reflect the opinion of Sachem Cove or its affiliates. And this podcast is for informational purposes only, and it should not be relied upon as the basis for investment decisions. Clients and or affiliates of Sachem Cove Partners may maintain positions in securities discussed on this podcast. This week, I hope you enjoy NHL hockey, playoff baseball, Thursday night football, whatever it is. Or if you don't like sports, then you won't enjoy it. So I'll be back next week, and I look forward to speaking with you then. Thanks.
The information presented on Talking Stocks Over a Beer is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.